Welcome to this week's episode of Jonathan on Money. This is episode number 162, and this podcast should drop right after I come back from my family trip to Israel because I know I have a contingent of listeners who are interested in my travel itineraries. I'll just spend a few minutes discussing some highlights of my trip for folks who are looking for travel ideas. I'll also, as always, end with a financial aspect of my trip that will hopefully be helpful to listeners as well. So when traveling, the key for me is to find ways to get my kids engaged. This is particularly true in Israel, which I've been to to dozens of times or more. I like my kids to see new things and to do new things for myself. Every time I go back, and everyone who knows who's been to Israel, there are plenty of new things to do no matter how many times you've been there. This time we began our Israel adventure in Tel Aviv, settling into the Dan Panorama and easing into the trip with a seaside walk along the Tayelet. The next morning, we enjoyed the breakfast at the hotel. Everyone knows that the Israeli breakfasts are great. We had time at the beach. We went swimming briefly before heading to my brother's Dovi's home in Ramat Beit Shemesh, where we spent Shabbos together. After Shabbos, for Malava Malka, we went to Rubens and Beit Shemesh for a great meal. The following morning, we explored the Sorek stalactite caves, enjoyed at lunch in Beit Shemesh at Greg's Cafe, and took part in the Dig for a Day archaeological experience, which I highly recommend if you have kids. From there, we continued on to Jerusalem, where we got together with family for dinner and at a fabulous taco place, which was different and enjoyable. The next day, we went with our tour Arki to visit Derech HaAvot, which I've never been to before, and Herodian, which is much cooler version of Masada. We also went to Maran Machpelah and toured Hebron. We then went to Nachal Tekoa and saw farmers building their latest development in Tekoa Zion. Truly amazing. That evening, we were joined by my friend Jake and had a lively shuk crawl for dinner featuring sabich, arayas, kuba soup, malawa, falafel, pastrami, and a flight of beer for Dad. The following day, we went to Eretz Bereshit, where the kids enjoyed meeting Eliezer and Avraham Avinu, baking pizza and riding on camels. We then proceeded to En Gedi for a short hike and had lunch at the Greg's near the Dead Sea, and then went to Ein Bokek Beach. That evening, we had dinner at Cafe Rimon on Ben Yehuda, which is always a family favorite. The following day, we took the newly available tour at Ir David, of which was the pilgrimage road, where during the times of the Beit Hamikdash, Jews would walk up that road to bring bikurim and karbanot. We had lunch in the Rova and explored the old city with Tzvi Sat, which included both the Jewish and Muslim quarters, which was super cool. The next day, we had breakfast with friends and went to the Kotel and did a shuk crawl with family. Shavuos was spent in our hotel, and we went to the Kotel another 4 times. And fun fact, Chabad, I believe it was Chabad, was handing out snacks all Shabbos and Yontif near the Yaffa Gate entrance to the Old City, which sparked joy in our lives. As always, if someone would like my itinerary or has questions about this trip, feel free to reach out directly to me. Now, here's the money lesson. Leading up to the trip, I was stressed about logistics and getting around Israel. My wife doesn't like renting a car in Israel because she thinks I'm going to end up making a wrong turn and end up in Gaza. But hiring drivers is generally pretty expensive, so I was trying to figure out cheaper options or itineraries. At the end of the day, what I realize is that sometimes in life, the money is not the most important aspect. So rather than stressing about spending more money, I decided to spend more money to elevate our experienced hire drivers and make our lives easier logistically. We ended up spending much more than we anticipated on transportation, but it was still within our means. I figured that in a few months, I won't even remember the costs. I'll only remember the things we did and the great time we had. The lesson is this: spend more money, still within your budget, of course, and use those extra dollars to enhance your life and travel experiences. If you don't use money to enhance your life, then what's the purpose of working so hard to begin with? Keep that in mind. In other news, don't forget to buy my book, D's for Diversification, the ABCs of Personal Finance, which is now available on Amazon or at jonathanmoney.com. Buying this book is a wonderful way to support this podcast. And finally, before jumping into this week's episode, I'd like to share that my upcoming live webinar series will continue on Thursday, May 28th at 8:30 a.m. featuring Asher Lowenstein, founder of Lowenstein Legal PLLC based on Long Island, New York. And Asher is going to be discussing designing resilient estate plans, planning to avoid litigation. And I'll include the registration information in the show notes to this episode. Okay, now for today's agenda. My talking point this week will discuss where does gambling fit into my investment strategy. Our quote this week is from Jim Carrey on why everyone should be rich and famous. I'll spend the last half of the episode answering listener questions, including why are dividend yields lower today than in past decades? And finally, we'll end with an actionable idea to implement your investing life, where we'll discuss simplifying your financial life. With that, let's jump into this week's talking points. So I received the following question from a yeshiva bacher the other week, which went as follows. There are now countless platforms that allow people to place bets on sports, geopolitics, financial outcomes, crypto, casino games, and more. Since some argue that the stock market is just another form of gambling, I'm wondering whether wagering on these other areas could fit into an investment strategy. All these activities are uncorrelated with traditional assets like stocks, bonds, and real estate, and they might improve returns over time if I'm willing to research my bets. Would you recommend taking advantage of this trend and speculating in these areas to enhance my portfolio's performance? And what is the rationale behind your answer? So let's be clear, gambling is not investing. It's a corrosive habit that erodes wealth and undermines sound financial decision making. While the platforms used to gamble may be slick and the opportunities seem endless, the risks far outweigh any potential rewards and will likely cause you to lose money over time. However, let's tackle each part of your question so you make smart decisions with your money and don't blow it on nourished kite. First, let's distinguish between investing and gambling. The line between the two has blurred in recent years, especially with platforms like Robinhood offering both stock trading and sports betting. However, Robinhood is not built for long-term investors. It caters to speculators chasing thrills, not disciplined savers building wealth. Financial firms may continue to drift into gambling territory if there's money to be made, which makes it even more important for investors to stay grounded. At its core, investing means allocating capital to a productive enterprise. When you buy a stock, you're purchasing a stake in a business that sells goods or services and generates cash flow. Real estate offers tangible value with property you can see, use, and rent out. Bonds represent loans to business or government with interest paid in return. These vehicles for long-term growth grounded in economic activity. Gambling, by contrast, seeks profit from volatility itself. It's not about value creation, it's about guessing outcomes. Whether it's betting on a game, a political event, or a crypto swing, the goal is to win based on chance, not productivity. When financial markets are treated like casinos through day trading, meme stock chasing, or speculative hedging, the line between investing and gambling disappears, but the consequences remain. Next, let's discuss the dangers of gambling. The dangers of gambling are well documented. In the US, about 22% of adults placed a sports bet in the past year. Online gambling continues to rise, with participation jumping from 6 to 10% of adults. Globally, nearly half of adults and 18% of adolescents gambled in the past year. Online formats are especially risky. Nearly 16% of adults and 26% of adolescents who use online casinos or slot products develop a gambling disorder. Sports betting also shows elevated addiction rates. Surveys of U.S. online sports bettors reveal troubling behavior. More than half chase losses, nearly 40% bet more than they feel comfortable with, and over a third report shame after losing. A quarter have lost $500 or more in a single day, and nearly 10% have sought help for gambling problems. Young adults are particularly vulnerable, and early exposure often leads to long-term issues. Public perception is shifting too, with 43% of Americans now viewing legal sports betting as harmful to society. Now, let's turn to halachic considerations. Beyond the financial and psychological risks, gambling raises serious ethical and halachic concerns. In Jewish tradition, gambling is consistently viewed as problematic. For example, the Talmud disqualifies dice players from serving as witnesses, reflecting a moral distrust of those who profit from games of chance. One opinion sees gambling winnings as asmafta, or money taken without full consent. The Rambam goes further, calling gambling rabbinically prohibited and labeling it wasteful and unproductive. As he explains, a Jew's life should be devoted to Torah growth and meaningful work that benefits society and not speculation detached from value creation. In a recent Musar Shmuz, Rav Aryeh Leibowitz a yeshiva university, highlighted how gambling has become normalized even among yeshiva students. This trend reflects deeper distortion in how we view money, with a casual attitude towards financial responsibility, diminished respect for honest work, honest effort, known as hishtadlut, and desires shaped by status and advertising rather than substance. Torah views money as divine trust, not a toy. Financial blessing comes through responsible effort and siyata dishmaya, not shortcuts or games of chance. Let me share. Now, let me just share some real life scenarios. While I advise people to avoid speculation of any kind, I understand the appeal. Everyone knows a friend or colleague who boasts about a big win on a sports bet, casino game, or lucky day trading streak. What we rarely hear about are far more common losses. It's human nature to broadcast our victories and stay quiet about our failures. And I'll never forget the client who came to my office proudly showing off his day trading success. He handed me his phone so I could scroll through his trading app and admire his winners. As I looked through his positions, I noticed several holdings that had dropped more than 80% in value. When I asked why he hadn't mentioned those, he brushed them off as irrelevant and insisted he preferred to focus on his winners. It sounds absurd, but it was also completely human. We all want to highlight our success and ignore our mistakes. The problem is that investing doesn't work that way. If you make too many mistakes, or even a few very big ones, you can derail your financial future. Gambling only increases the likelihood of those mistakes. It raises the probability of destroying a family's finances, not improving them. Here's the bottom line. For investors, the takeaway is very clear. Risk in pursuit of productive growth is legitimate. Risk in pursuit of thrill or easy money is spiritually corrosive and will likely be financially devastating. The difference lies not just in strategy, but in mindset. Investing requires patience, discipline, and humility. Gambling feeds impulsivity, ego, and fantasy. I'm not a rabbi or posek, but I strongly discourage gambling of any kind. It's a slippery slope, and the trade offs are rarely worth it. Tying your financial future to chance is irresponsible and unlikely to end well. A sound investment strategy avoids speculation on sports outcomes, geopolitical events, or market timing. Instead, it focuses on long term goals, diversified portfolios, and steady progress. A good rule of thumb is if the investment feels exciting or gets your adrenaline pumping, it's probably speculation. And the best investment strategies are plain vanilla and boring. That's not a flaw, it's a feature of how to build long term wealth, afford a firm lifestyle, and achieve all your goals. Okay, those are the talking points this week. As a reminder, you can be notified of all my recent articles, webinars, and all the work I put out by subscribing to my free monthly newsletter at parkbridgewealth.com/newsletter. This week's quote is from Jim Carrey. For those who don't know, Jim Carrey is a Canadian-American actor and comedian known for his physical comedy and expressive performances. He rose to fame on In Living Color and became a 1990s box office star with his hits like Ace Ventura, The Mask, and Dumb and Dumber, one of my favorite movies. He later earned critical acclaim for dramatic roles in The Truman Show and Eternal Sunshine of the Spotless Mind. And Carrey once said, I think everybody should get rich and famous and do everything they ever dreamed of so they can see that it is not the answer. The message here is not that achievement, wealth, or recognition are meaningless, but rather that they are often treated as solutions to deeper emotional and personal needs they were never designed to solve. Many people spend years believing that once they reach a certain income level, career milestone, or lifestyle, they will finally feel complete. Yet even those who achieve extraordinary success frequently discover that happiness, purpose, and peace of mind cannot be purchased or guaranteed by external accomplishments alone. As they make reference to on occasion, in the world of Hollywood, we see a lot of behavior on what not to do and how not to live. It's refreshing to see someone from Hollywood so in tune with where meaning does not lie. Keep in mind that if you are unhappy or unsatisfied with certain aspects of life, being financially successful and famous will not fix your problems. They will just mask them over temporarily, and you will still be miserable inside. The key is looking inward and making adjustments to underlying root of your problems and lack of happiness. And I think this idea has an important connection to investing and financial planning. Financial success can provide freedom, security, opportunities, and reduce stress, all of which matter greatly. However, money works best as a tool rather than a destination. A thoughtful financial plan is not simply about accumulating the largest possible portfolio, but about aligning resources with values, relationships, experiences, generosity, and long term purpose. Investors who constantly chase more without clarity about what they truly want often find themselves trapped in an endless cycle of comparisons and dissatisfaction, even as their wealth grows. Okay, now let's jump into this week's financial questions. And if you do have a question, feel free to submit it to me, and it may be answered in a future episode. Okay, first question. Explain to me why I shouldn't just put all my money in the Nasdaq tech stocks since it's been the best returning asset class over the past decade and a half. I want to first apologize to all the listeners who have heard a version of this question about 2 dozen times. I guess my answers aren't getting through, or you're a new listener, or you just don't appreciate risk. Let me try answering this question in a different way. If you appreciated what was at stake, you wouldn't be so cavalier with the way you invest your money, i.e., in just one area of the market. In other words, the whole purpose of investing is to achieve your goals. This may mean being able to retire at some point, helping out your kids, paying for a SIM card, or simply not needing to depend on family members later in life to help you make ends meet. When you think about investing from that perspective, then the idea of concentrating your whole portfolio in one area of the market is just insane. Why would you take that level of risk when your life literally depends on that money? Furthermore, the approach of investing that revolves around achieving the highest possible return is the wrong one. It will only lead to taking excessive risk and likely blowing up a portion of your portfolio or all of it. You don't need high returns to achieve your goals. You need the equivalent of singles and doubles with some regularity to be able to amass a fortune and live the life you want. Investing your life savings in a way where you can be totally wiped out, down 80%, and take 15 years to recover is a sure way to you up for failure. I hope this answer helps you appreciate risk, why your thought process doesn't make sense. If not, I imagine that someone else will ask a version of this question again in a few weeks. Next question. I'm retired and have about 40% of my assets in income annuities. I recently received an inheritance that makes up about 60% of my assets, and my advisor advised me to take 20% of this money and put it in low cost annuity. What do you think? I think your advisor works for an insurance company and is being compensated with juicy commissions to push his firm's products, or he works as a salaried employee for an asset management firm that has their own annuities and is receiving a bonus for pushing this firm's products. I can pretty much guess which firms your advisor works for, but I won't badmouth them in public. Either way, putting more money into annuities, which is an illiquid financial product with high fees, is inappropriate. So, first, you should fire your deadbeat, brain dead loser advisor. Next, you evaluate how much income you need to live your life. If you don't need more income currently, then you should invest in the market split between stocks and bonds. This will allow the portion of your portfolio to grow as life becomes more expensive due to inflation and inevitable rise in healthcare costs. You will also have a large pool of assets to draw upon in the future. However, if you do need more income to live on, you can meet with a normal advisor who's not a used car salesman, and hopefully they can advise you on the best approach, which should not include buying more annuities. As a rule of thumb, more than 20% of one's portfolio annuities is probably too much. Next question. My CPA made mistakes on my return this year. Should I fire her and find a new one, or is that too reactionary? It depends on the type of mistakes, if this is a consistent problem or one-off thing, and do they acknowledge their error and take responsibility for it. If this is ongoing and there's no responsibility taken and there are fines, etc., then it may be time to find someone else. I've worked with enough professionals in my life where I can appreciate the fact that sometimes things get overlooked. It's frustrating, but it happens. No one is immune from making occasional errors. As long as it does not occur regularly and this person acts professionally about it, then you could chalk it up as a small speed bump and just move on with life. However, if it's an ongoing problem and no responsibility is taken, then make a change. The fee isn't worth their work and your aggravation. Next question. My advisor rebalances my account every year. The issue is, since the market has gone up, I will get hammered on taxes when she sells my gains. Is it worth rebalancing if there is an onerous tax burden? So it depends what your priorities are. If the market went up, that means that equities make up a higher portion of your portfolio, which means you are now taking more risk compared to earlier in the year. If you want to manage risk and minimize volatility, then rebalancing makes sense. If your focus is on tax management, then don't rebalance. Own exclusively growth stocks with low or no dividend. Embrace the volatility and hope things keep going up until you need the money. There are no free lunches in life. It's all about trade-offs. This decision is between risk management and taxes. Decide what is important to you. Personally, I believe in being tax conscious, but won't let taxes drive my portfolio decision. That's why I rebalance clients' accounts when necessary, despite it triggering a taxable event. Seems more logical to me than being paralyzed by taxes. Okay, next question. With rates falling, where should I put my cash? Short duration bond funds and mortgage bonds look interesting given their higher yields than cash. Dude, you should keep money in cash if you need the funds in the near term. It should not be there because you are looking for an attractive return. If you have near-term expenses, you should have funds in cash or even if there is no return. For higher returns, you should move to equities. When rates fall, investors always make the same big three mistakes, which are one, they reach for yield by moving out of cash into more speculative investments with a higher yield. Two, they go down in credit quality with bonds by investing in below investment grade fixed income. And three, they extend their duration on their bonds from short term to long term to pick up more yield, which leads them to take equity like risk without the upside potential. Stupid, senseless. Get your head out of your tush and stay focused on what actually matters. Sorry, that was harsh. Let me try that again. Stop mucking about, get your head out of your anus, and direct your attention towards which truly bears significance. Next question. Gold is going nuts. Thoughts on including it as part of one's portfolio? So I personally don't own any gold, but I understand why some investors have a small weighting to it. Market history is important to understand my position. So gold was up almost 30% per year in the 70s, which was when Nixon ended the Bretton Woods system that pegged gold to the dollar. It was also a decade with sky high inflation, oil price shocks, and weak dollar government spending, and consequently, it caused gold to skyrocket. However, in the 1980s, stocks exploded higher and gold got crushed. In fact, gold had a drawdown of nearly 70% and a negative return for nearly 20 years. On an inflation-adjusted gold didn't pass the high from the early 1980s until last year. That had to suck for gold investors. Then, just when everyone had given up on gold as an asset class, there was a lost decade for the S&P 500 in the 2000s, while gold had a big recovery. All that being said, gold is a decent diversifier, especially during tough decades for stocks. It's also been used as a form of currency or asset for thousands of years. That history has to be worth something. So why don't I own any gold? Part of that is the fact that it's not a productive asset. It doesn't do anything. There are no earnings or cash flow. Another reason is I'm big on innovation, and gold seems like a relic to me. However, I think it really boils down to the historical returns I just mentioned. I know stocks go through booms and busts and lost decades, but gold went on such a terrible 40-year run that it makes me nervous to hold it for the long run. Then you had a good decade in the 2000s that was more or less followed by yet another lost decade into the 2010s. From 1980 through the year end 2019, these were the total returns for gold and the S&P 500. Gold, positive 197%. S&P 500, positive 8,242%. So you're looking at annual returns of 2.8% versus 11.7% respectively. The worst part is that annual inflation rate was 3.1%, meaning gold lost money to inflation over a 4-decade long stretch. Now you could say I'm cherry picking data here. If you include the 70s, the long-term returns for gold look much better. Since 1970, gold has been up more like 8.5% per year. I just don't have the stomach for an asset that has the ability to experience 3 lost decades out of 4. If you want to include gold within your portfolio, you need to understand this history, appreciate that history can repeat itself, and only carve out a small portion of your portfolio relative to your exposure to other asset classes so it doesn't serve as a huge drag on your portfolio when stocks are rising, which they usually do. Next question. I look at my statement every month and can't help but wonder how much more money I'd have if I didn't pay my advisor a fee and did everything myself. Thoughts on this? I don't know who you work with and what advice they have given you or how they've been managing your portfolio, but let's assume they're a good advisor, giving sensible advice, presumably why you decided to work with them in the first place. In that situation, you're thinking about your situation the wrong way. You're assuming you would have made all the same decisions if you didn't work with an advisor. You should really think about it the other way. If you didn't work with an advisor, how much worse would you be doing and how much less money you would have? When new clients come to me who previously didn't have an advisor, I'm astonished at how many wrong decisions they have made. On a very basic level, they have way too much money in cash, which means they missed out on many years of growth in the market, which compounds at a much greater rate than your advisor fee. This bad decision alone has meant millions or hundreds of thousands of dollars of less overall wealth. Most people are not confident investing their money without guidance and of professional telling them and pushing them to do so. This leaves them significantly poorer than if they had hired someone to help. Another fairly basic item is they are rarely taking full advantage of tax advantage accounts. Yet, another basic item is they are not invested the right way and are often taking too much risk. Additionally, they are rarely on a program to regularly grow their wealth. I haven't even scratched the surface on missteps people make, which are compounded if they actually have money and there are trusts and other planning techniques involved. The culmination of all their bad decisions or indecisions has cost folks more money than what any normal advisor would charge. In my expert opinion, that's the more relevant perspective to consider. The thought process of saving money by not hiring a professional with more experience and expertise is a poor man's approach to the world. It's trying to pinch pennies while losing sight of the bigger picture. Successful people surround themselves with high caliber professionals and pay them for their services. That's how to get ahead in life and with your money. Next question. Why are dividend yields lower today than in past decades? Interesting question. I'm not an expert on this issue, but one reason may be due to the popularity of stock buybacks, which is essentially the same thing as a dividend in a different form, which are more prevalent today. Share repurchases also increase earnings per share by reducing the number of shares on the open market. Your Shiloh points to a more important issue, which is when folks invest the same way their parents or grandparents did. Remember, market dynamics change, as you highlighted in your question, and new and more innovative strategies and products may come on the market over a multi-decade time frame. Investors who pursue a strictly dividend-focused approach, like their parents and grandparents did in the past, have suffered in terms of returns. You need to evolve your investment strategy over time or risk leaving a lot of money on the table. Next question. I recently discovered the tax efficiency of passive investments. Should I liquidate my entire actively managed portfolio to move into passive strategies? First of all, in some areas of the market, actively managed strategies are more sensible. I know it's easier to listen to sound bites from personal financial bloggers on social media, influencers spew, but the reality is never so clean and neat. In many areas, a passive approach will work better, but this is not the case for the entire market. Now, let's get back to your question. A big part of your decision comes down to the tax liability from overhauling your entire portfolio. If it is a large tax bite, you may want to either stick with some active funds or sell those funds over time and not all in one shot. I'm fond of saying that the tax tail should not wag the investment dog, but to disregard taxes completely is ill-advised. Another point to consider in your time is your time horizon. If there is a large tax liability, but you have a very long time horizon, it may be worth getting hit on taxes once and then spending the next few decades with a much more streamlined and tax efficient portfolio. One more idea is perhaps building your portfolio with new cash inflows and dividend payments in a more tax efficient manner. Over time, the active portfolio will make up a much smaller portion of your investments. Like I said, not every decision is so simple. Most situations are far more nuanced, and various considerations need to be assessed in order to determine what makes the most sense for you and your family. Okay, that's it for financial questions this week. And by the way, if you have a more involved personal finance situation, feel free to reach out directly to me and perhaps my team and I can help you. The best way to get a hold of me is via email at jonathan@parkbridgewealth.com. And finally, I'd like to end with a timely and actionable idea to listeners that can implement to their financial life. And today's timely idea is regarding retirement readiness. Before handing in your resignation letter, it's important to simplify your financial life. This is something I talk about often. Keeping your finances consolidated and organized is always sensible. This is even more important as people age. As a youngster, you may be able to more easily track your multitude of accounts at various brokerage firms. This will become increasingly more cumbersome and stressful as you get older. I suggest to all my clients approaching retirement to consolidate their accounts wherever possible. This includes rolling over all old 401ks, consolidating various IRAs and taxable accounts where appropriate, and managing all checking at one institution. Furthermore, having a seamless process for a child or trusted family member to make decisions on your account in case you no longer have capacity will save you a lot of heartache and frustration later. And with that, it's a wrap for this week's show. Any comments or questions, feel free to reach out directly to me via email. I love hearing from my listeners. And finally, the secret to financial success is no secret at all. It's to spend less than you make, invest the difference prudently, and ignore all the noise. See you next time on Jonathan on Money.